Welcome to The Explainer. Today, we are going to totally demystify the stock market. We're cutting through all that confusing jargon so you can finally understand what's going on, feel way more confident, and maybe even start investing yourself. So, have you ever listened to the financial news and it just sounds like a completely different language? You hear things like PE ratio or volatility and your brain just checks out? Yeah, you are not alone. But stick with me because we're going to make it all click. All right, here's our game plan. We're going to start with what a stock even is, then how you buy one, how to pick them, how to read the market's mood, and finally, we'll open up the investor's detective kit. Let's do this. First things first, let's tackle the biggest question of all. When you buy a stock, what are you actually buying? Let's break down the absolute most important building block of the whole market. Okay, I want you to picture a giant company, like Apple, as one big pizza. When you buy a stock, you're literally buying one slice of that pizza. That's it. It makes you a tiny, tiny part owner of the whole company. Pretty cool, right? So, where do you get these pizza slices? Well, you go to a special kind of supermarket. It's called a stock exchange. You've probably heard of the big ones, like the NYSE or the NASDAQ. It's just a giant marketplace where all these slices are bought and sold every single second. And just like in a supermarket, every pizza slice needs a price tag, right? In the stock market, we call that the ticker symbol. Think of it as the stock's nickname. It's just a short code like APL for Apple or TSLA for Tesla, so everyone knows exactly which slice you're talking about. Now, once you start collecting these different pizza slices from different companies, you've got yourself what's called a portfolio. It's basically your own personal collection. Think of it like a sticker book, but instead of shiny dinosaurs, it's filled with valuable pieces of real companies. Okay, section 2. So you know what stocks are, and you know they live in the giant stock supermarket. But how do you actually walk in there and buy one? Let's get into the nitty-gritty of making your first move. Well, you can't just walk onto the floor of the stock exchange yourself. You need a guide, a middleman, and that's your broker. Today, it's usually just an app or a website, like Fidelity or Robinhood, that places the order for you. When you tell your broker to buy, you've got two main choices. A market order is basically the I want it now button. It just buys the stock at whatever the current price is, fast and easy. A limit order is more like telling your broker, hey, I only want to buy this if the price drops to this exact number. It gives you a lot more control. Now, what about protecting your money? That's where something called a stop loss order comes in. It's your automatic safety net. So let's say you buy a stock for $50. You can set a stop loss at $45. If the price ever falls that low, your broker automatically sells it for you. It's a great way to stop a small loss from becoming a huge one. All right, you know the rules of the game. Now it's time to choose your players. Because just like in sports, there are all different kinds of stocks you can put on your team, and they all have different skills. First up, you've got common stock. This is, well, the most common. It means you're an owner and you get to vote on big company decisions. Then there's preferred stock. With this one, you give up your right to vote, but in return, you get to stand at the front of the line if the company pays out cash. It's like a VIP pass. And this is where it gets really fun. You get to be the team manager. You can pick blue chip stocks. Those are your big, reliable team captains, like Coca-Cola. Or you could go for growth stocks, the speedy young players with tons of potential. Value stocks are like the underrated players that nobody's really noticed yet, but you think they're a steal. And dividend stocks, they're the players that literally pay you a cash bonus just for having them on your team. Okay, let's zoom out a bit. Instead of looking at individual players, let's look at the whole stadium. How can we tell what the mood of the entire market is? Are people feeling good, or are they getting nervous? For whatever reason, Wall Street loves its animals. You'll always hear about a bull market. That's when things are great, and prices are charging up. Just picture a bull thrusting its horns upward. The opposite is a bear market. That's when prices are falling. Think of a big bear swiping its claws down. Up like a bull, down like a bear. Easy. Here's a word you hear all the time, volatility. It sounds complicated, but it's not. It's just the stock's energy level. A stock with high volatility is like a puppy that's had way too much sugar. Its price is jumping all over the place. A stock with low volatility, that's more like a sleepy cat. Calm, stable, not a lot of drama. We also group companies by size, using something called market cap. You've got your large caps. Those are the giants, the household names like Apple. Then there are mid caps and small caps. They're the smaller up-and-coming companies. They might have more room to grow, but that also can mean they're a little bit riskier. Okay, last section. We're opening up the investor's detective kit. These are the tools that savvy investors use to check out a company and decide if it's actually a smart place to put their money. So when you're picking stocks, there are two main schools of thought. Fundamental analysis is when you play detective. You dig into the company's health, how much money it's making, what its business plan is. Technical analysis is totally different. It's more like being a fortune teller, studying charts and patterns to try and guess where the price will go next. A really key tool in your detective kit is the PE ratio. All it does is ask a simple question: is this stock a good deal? It just compares the stock's price to how much profit the company actually makes. A really high PE might mean the stock is kind of pricey, but a low one could mean you found a hidden bargain. And now we have to talk about maybe the most powerful force in all of finance, compound interest. It's like magic. Imagine your money is a little snowball at the top of a hill. As it rolls, it picks up more snow. That's your profit. But then it starts earning profit on the new snow too. Over time, your little snowball can turn into a giant avalanche of money. And that brings us to what is maybe the number one most important rule of all: diversification. You've heard it a million times. Don't put all your eggs in one basket. That is literally all this is. If you spread your money out across lots of different stocks and one of them does poorly, it's okay. The others can help pick up the slack. So you've got the lingo now. You know the language of the market. But that leads to a really big question, especially today. In a world where we have endless information and AI telling us what to do, is the real risk not knowing the terms? Or is it knowing all the terms and still just blindly following the crowd? Learning to think for yourself? Well, that's the real secret.